Welcome back to Investing Talk Podcast.
Today we're looking at SoFi Technologies, or SoFi.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For a company that, was founded primarily on student loan refinancing, the biggest story right now is really its durability.
And the consistent execution. It's one thing to grow, but it's another to do it profitably.
Absolutely. We have seen, 8 consecutive quarters of profitability, which, that provides huge confidence in the model.
A huge amount. And if we look at the third quarter of 2025, the numbers are, they're pretty strong. Net revenue hit $962 million.
Which is a 38% increase year over year. That's not slow growth.
No. Right.
And that revenue growth is translating directly to the bottom line. Q3 net income was $139 million.
And the adjusted EBITDA, that jumped 49% year over year to $277 million.
Right. And these are results that, they significantly outperformed what analysts were expecting.
It's just impressive when you consider the whole growth trajectory. Think about it. The company has exploded from just, 650,000 members in 2018?
Yeah, something like that.
To over 12 million members and 18 million products today.
And they're consistently outperforming the Rule of 40.
Which is so key.
They're averaging 58% over the last 16 quarters. For a financial company, that's almost unheard of.
So that financial health, it seems like it's being driven by a really critical strategic shift, right? Away from just being a lender.
That's the whole story. When the current CEO joined, 100% of revenue came from lending.
100%. Wow.
And now lending is down to about 45% of total revenue.
So that means the non-lending parts, the fee-based segments, are providing that margin stability.
Exactly. Those segments contributed over half of total revenue in Q3 2025.
And they're growing fast.
A 57% year-over-year growth rate. So this diversification, it dramatically reduces that capital intensity risk.
Okay, so that financial services productivity loop model they talk about, it actually seems to be working.
You can see it clear as day in the cross-buy metrics.
Right.
40% of new products are now being opened by existing members. They don't have to go out and acquire that customer again.
And the financial services revenue per product is hitting 104 times for the first time.
So the whole focus is on increasing engagement among this, sticky, digitally native user base they've built.
We really can't talk about the diversification without highlighting the technology platform, Galileo.
No, you can't. That's the engine. It's the engine behind the whole B2B revenue stream.
And they just made a huge move to strengthen that engine, didn't they?
Oh, yeah. By joining the Amazon Web Services Partner Network.
So what does that integration actually mean in practice?
It means that fintechs and banks that are already using AWS can deploy Galileo's full suite of tools.
So things like card issuance, transaction processing.
Exactly. Fraud management. They can deploy it directly within their existing cloud setup.
That's huge. That move gives Galileo exposure to AWS's massive global ecosystem. I think it's over 130,000 partners.
It is. It's a huge competitive differentiator.
Yeah.
It really proves that the technology they built for themselves is now a deployable service for others.
So the ability to just simplify payment operations without a heavy IT investment, that's a powerful value proposition.
A very powerful one.
Okay, so looking ahead, the company seems to be positioning itself right at the center of two big technology supercycles.
AI and digital assets.
Yeah. They have over 40 AI proof of concepts in development right now.
And these range from, defensive uses like speeding up account, takeover remediation, and resolving disputes.
Right, the efficiency stuff.
To more offensive tools, like that thing they call the Cash Coach.
So the goal with the Cash Coach is to evolve it into a full AI assistant.
Pretty much. One that proactively answers the question, what must you do, what should you do, and what could you do today to get your money right?
That level of personalized advice is only possible because they have all the user data consolidated.
Right. They see everything across all financial products. That's the key.
And on the digital asset side, they announced the launch of SoFi Crypto.
Which makes them the first national bank to offer crypto trading in the U.S.
That regulatory stamp of approval, that provides a pretty significant trust advantage over competitors, doesn't it?
A massive one. But crucially, they also plan to launch a SoFi USD stablecoin as early as January 2026.
Okay, so this is the interesting part. What's the key advantage here? A stablecoin is a stablecoin, right?
Well, not exactly. The key advantage is that the reserves will be held in a Fed bank account,
In a Fed count. Okay.
which offers users zero credit, liquidity, or duration risk. It's a major selling point.
So they can market this to basically every large and regional bank globally.
That's the plan.
Let's switch back to the lending side for a minute. Even though it's a smaller piece of the pie now, it seems like macro trends could provide a huge boost.
For sure. I mean, if we see the expected rate cuts, student loan refinancing and home loans will gain significant momentum.
And they are strategically focused on the personal loan market, right?
Yeah.
Targeting that massive credit card debt issue.
Yeah, they essentially act as a refinancing engine. They move customers from, say, 25% credit card interest rates down to around 12% on a personal loan.
And they do it without prepayment penalties.
Right. It's a win-win.
Plus, there's that potential regulatory opportunity if the government stops funding Grad Plus loans.
Then the company is perfectly positioned to step in and offer financing in that highly attractive graduate loan market.
So we have to balance all this growth against the stock's performance. The share price has climbed dramatically.
Oh, yeah. Over 105% year to date.
So that rally has led some analysts to currently hold a neutral consensus.
The argument is that the valuation has gotten a bit stretched.
And yet at the same time, we're also seeing a heavy institutional accumulation score,
Right. Many large institutions are significantly increasing their stakes.
which suggests they have confidence in the long-term structural growth story, not just the quarter-to-quarter numbers.
I think so. When you look at the fundamental transformation of this company, from just a lending service into a truly diversified, profitable financial platform.
With its own B2B tech and this push into AI,
Yeah.
it presents a pretty compelling picture.
It really does. The short-term valuation concerns are, for some, offset by the sheer number of long-term structural tailwinds.
Absolutely. The biggest question for you to consider is whether the combination of their unique bank charter and this aggressive pursuit of the digital asset and AI space.
Truly provides an unassailable advantage.
Right, an advantage over both legacy banks and, the pure play fintechs.
Great mood for thought.
Don't forget to subscribe to Investing Talk podcast for all our latest analysis.